Traditional businesses are coming back, and startups might not be as hot as they used to be. IBM, sexier than Tesla? Let me explain. When you think about startups, I'm sure you think of cool offices with slides and free meals and electric scooters. You think of innovative tech and shit tons of money. You think of disruptors like Airbnb, Netflix, Bumble, WeWork, and the list goes on. From the outside, it's all sunshine and rainbows. We're always fascinated by the latest and hottest thing, but the reality is far less glamorous. This got me thinking, if the goal is to make more money, does it really matter how you do it? Of course, you don't want to make your cash doing anything illegal or putting people or the environment in harm's way, but does it really matter if the return on your investment comes from a cool tech startup or a boring old school business? There's this conversation happening right now about traditional versus startup models, and I see a huge opportunity. I'm going to break down why traditional, boring businesses like car washes and laundromats might make you more money than innovative industry disruptors. And then in my next video, I'm going to prove it using case studies like Uber and Spotify. First, let's take a step back. What is even the difference between traditional businesses and startups? Traditional businesses typically have a top to bottom organizational structure with rigid processes. They tend to have a conservative approach and are usually slower at adapting to change, decision making, and innovation. Many are brick and mortar stores or provide physical services catering to a specific geographic area. That said, being risk averse and prioritizing incremental growth creates a level of stability amongst these more traditional companies. Startups are kind of the opposite. They operate at a fast pace, value technology and innovation, are far more agile, and embrace risk-taking. The focus lies in the disruptive ideas and encourages a dynamic culture. The goal is to expand rapidly and change the game along the way. Startups generally rely on external funding, like venture capital to support early growth stages, while traditional businesses typically lean on established revenue streams and conventional financing methods, like bank loans. The distinction lies in the established versus adaptive nature of their structures and the willingness to explore new, uncharted territories. I know on paper, startups seem so much more fun and exciting, but let's talk about what's really important: making shit tons of money. Traditional businesses, or should I say boring businesses, are focused on making consistent profits. Investors make a return when the business earns more money than it spends and distributes these profits amongst its shareholders after taking out a portion to reinvest in the growth of the business itself. The goal is to build a model with great processes and systems to maximize profits, which then increases the value of the company, maximizes returns to shareholders, and entices more investment and expansion. Startups, on the other hand, generally aren't as fixated on profits. Rather, the focus lies in the high growth and disruptive innovation. These businesses are funded by investors and venture capitalists who see an opportunity to gain a return primarily through an exit. For example, when the company is sold to a larger business, or listing the company on the stock exchange and cashing out after its exponential growth. Take the example of Apple and Uber. Apple, a traditional business, saw a gross profit of $167 billion last year. Uber, a startup, has yet to make an annual profit. Investors are drawn to Apple given the returns they can make on dividends and growing share prices, because Apple is so profitable, whereas investors in Uber back the growth potential of its share price or the opportunities that might come from an exit. Here, Uber's share price is driven by potential, not profit, but more on this in our next video. I feel like when I was growing up, we were taught to measure the success of a business with profit in mind. Nowadays, people don't look at the profit the same way. But why is that? Firstly, people have realized that taking profits is not the only way to make money. Strategic exits through IPO and the sale of business can result in a huge payday without needing the business to actually make money. Take the example of Instagram, which was bought out by Meta for $1 billion without ever generating revenue. Meta saw the potential to monetize from Instagram's growing user base, so invested, again, based on the potential, not profit. For the owners of Instagram, not building a revenue generating, let alone profitable operation didn't matter, as their payday came through the sale of the business. Startups also employ this idea that speed of growth and stealing the market share is more important than profitability. You sacrifice profitability today to super fuel your business and make more money tomorrow. What's interesting here is how we perceive the value of money. The idea of having cash in the bank is great, but what we sometimes forget is the value of that money. Take the example of inflation. As the cost of everything goes up, the power and the value of your money just sitting in the bank decreases. The more conservative approach held by traditional businesses of preserving profits and slowly reinvesting in business growth could be a missed opportunity. Generally speaking, traditional businesses are also impacted by taxes, more so than startups. Countries like Australia have a corporate tax rate of 30% and up to 47% on personal income, which means that you could lose more than 1/3 of what you make through taxes. For startups that aren't profitable, your tax bill is minimized because you're not making money. So rather than cashing out on profits, pumping that into the business fast tracks that path to success. Get what I mean? Would you rather take 5 to 10 years to grow the business using retained profits year on year after paying large amounts of taxes like a traditional business would? Or would you rather supercharge your growth with long-term potential in mind? Many startups are also driven by impact over dollars in the bank. They start with the goal of sparking change and are less concerned about the commercials. With younger employees entering the workforce that value the contribution they're making to the world around them, it's easy for startups to attract talent by coupling their purpose-led mission with empowering employees with a voice and a piece of the pie. But how sustainable is it to operate a business that grows without profit as a priority? Honestly, I think there's this glorification of startup culture. Yes, there are unicorns we can point to like Airbnb, Pinterest, and DoorDash, but for every Instagram, there's thousands of failed startups that we don't hear about. And of the ones that we do put on a pedestal, many aren't successful in profit or loss terms. Trust me, as an accountant who's been in the industry for more than 15 years and who has worked with thousands of businesses, I've seen my fair share of horror stories. Failed marriages, broken homes, deceitful relationships, and financial debt which could take years to recover from, all because of individuals sacking their whole life savings, career, or mortgage onto a business venture that leaves a trail of destruction behind. Don't get me wrong, I'm not telling you to not kick off your startup by any means. All I'm saying is that chasing the path of a unicorn doesn't guarantee that you'll catch it. We hear about the 100 times returns that people have made throwing money in what are now global brands. But what we don't speak enough about are the ones that don't make it. So if you're an investor, it's very easy to be caught up in the hype. But what might be a better gamble are boring businesses, car washes, laundromats, accounting practices, plumbing services, door repairs, nowhere near as sexy as innovative tech, but much easier to predict and far less volatile. Rather than putting your money in a business that may or may not skyrocket on its path to disrupting the market, why not invest it in something safe that guarantees you a steady return? There will always be a need to wash cars, refurbish homes, or fix toilets. Sometimes investing in a boring business and adding value by finding areas to optimize and improve can yield a better return than startups can. Tech startups have as high as a 99% failure rate compared to boring businesses like laundromats, which have more than a 90% success rate. Yes, the ceiling of a startup is higher, but the floor is also a lot deeper. Compared to gambling on a unique, money-sucking idea that may or may not fly to the moon, don't dismiss the earning potential of running a safer, more stable, boring business, especially when you can rinse and repeat the model to grow your investment portfolio. I know I mentioned that we'll get into this more in our next video with examples like Uber and Spotify, but there are some really recent examples like WeWork filing for liquidation or bankruptcy, or the financial struggles of Bumble leading to its CEO stepping down, that just adds to my point of the trust and security that comes with traditional business models. WeWork, for example, even though it was doomed to fail from the start, took so long to fail because of how investors pumped more money into the company to maintain its value, knowing that profitability would always be a challenge. Boring businesses don't have this problem because the proof of concept is already there. I feel like with growing economic challenges and the looming recession, the way we do things has to change too. I think a hybrid model which strives for profit but also looks for growth and investment is the only way to go. especially when the need for the startup companies to turn over a profit to survive in challenging economic times is a must. Money is not cheap anymore due to the rise in interest rates and slowing economy. So profit-generating businesses can manage cash flow and hold out in a recession better than a startup can. Let me know what you guys think. For now, that's all from your friendly neighborhood taxman. See you guys next time.